And thank you for the opportunity to speak with you this very, very cold January morning. Yes, my name is Dave Watson, and I've been a partner with WPG, the Wealth Planning Group, since 2000. We're going to talk about farm retirement planning, what things that influence farm retirement. Generally, a farmer does not have a specific date in mind. If they're healthy and happy, there is no pressure to retire. And we find that health is definitely the leading factor in retirement for farmers. Attitudes towards retirement, and I have to apologize a little bit, my internet crashed, so we're doing this a little bit old school here this morning. But attitudes towards retirement, a farmer's definition of retirement can be quite different than many other non-farming people's definitions. A farmer may consider himself retired when he no longer is doing the day-to-day work or making all the management decisions. Again, poor health is a primary reason for retirement, and even though he considers himself retired, he may be active and help out on the farm at the busy times. Farmers plan for retirement. It's interesting to know that research has illustrated an interesting fact. Farmers are the least likely of all self-employed to take part in retirement workshops. They find themselves too busy. The complications are almost always involved in farm retirement planning, and procrastination is easy when dealing with family dynamics and pressures. Problems with retirement. Farm retirement reeks of problems and stressors. The transfer of any family-owned business is said to be the most agonizing experience, and this is especially true in farm family business. Lots of potential for family conflict. The division or sale of assets will most likely affect the viability of the farm. Debt and cash flow issues, and income planning now has a complexity to include mom and dad as well as the child that's taking over the farm. It can be especially stressful for the younger generation as well, as they feel they have no control over the timing of the transfer. Stressors are things that I like to call pillow talk. It's interesting, when I talk with parents and farming children, the stresses are all very real, a little bit different on each side, but one specific stress is what I call, again, pillow talk. When the son and daughter-in-law talk, quite often they worry about their future, their security, their destiny, and these are all determined by the parents' actions and timelines. The parents' reluctance to transfer the farm is directly related to these son and daughters' concerns about their future. Again, these add more stresses and put pressures on both sides of the family. A person retires and they have to start living off of their investments. It's the point in time when I say, now what? You've retired, you need to live off your investments. This is where the statement, it's not what you have that counts, it's what you get to keep that really counts. And some investments do receive preferential tax treatment. Things like tax-free savings accounts, registered investments, dividends, and one that I specifically like is insured annuities, all have tax preferential treatment. Retirement planning. When a farmer is planning their retirement, they're going to ask themselves many questions, or many questions are going to race through their mind. And these are the questions that all start with the words like will, when, how much, where. They're going to be concerned, will they have enough money to retire? When will they be able to retire? How much should they have to save for retirement? Where will the money come from? And what are the chances of running out of money? These are all real questions. Retirement income. When we're looking at retirement income, it's going to come from various sources. These will include different things like Canada Pension Plan, old age security, non or off-farm pension potentially, RSPs and RIFs, investments from non-registered savings, farm-related or government programs, and rental income. These are all sources of income for retirement. Old age security is an interesting one. At age 65, you become eligible for a taxable benefit called old age security, or commonly known as OAS. In 2009, the maximum benefit for OAS was $6,200, and the government has raised it this year to $6,481 for 2012. Clawback is the point where the government has decided you are independently rich and they want your OAS money back. If you have taxable income in excess of $67,668, the government will charge you an extra tax of about 15% until all your OAS is clawed back. If you are concerned about your OAS and the clawback, there are strategies that you can help to avoid the clawback. And these will include things like income splitting with your spouse, alternative or non-registered investments. There's some new investments out that are called guaranteed withdrawal benefit type investments that do have some tax advantages when you start taking income from them. And you can delay in taking income from your registered assets. There are a few things that you can do to help offset the OAS clawback. One of the favorite ones of mine, or one of the greatest ones I think, is of guaranteed investments is an insured annuity. An insured annuity can provide great cash flow and reduce your OAS clawback. An insured annuity, the way these work is they work really well for a person that has some assets that want to invest. They want to use the maximum or maximize the use of these assets while they're alive, and then at the end of the day they want to return the principal at time of their estate to their children, to their estate, or potentially charity, whichever is important to them. That money would be returned again at time of their passing. Here is an example of how they work, and we'll compare an insured annuity against a GIC. So in the chart that you're looking at, it shows a GIC on the left-hand side and an insured annuity example on the right. We're going to use for this example $1 million. We'll use an interest rate of 4%, and I'm just using a 44% marginal tax rate. It's important to understand that that rate can change province to province or by personal situation. So if we have $1 million invested in a GIC and we're getting a yield of 4%, the annual income we're getting is about $40,000. If we're taxed at the higher rate, around 44%, there's about $17,600 that's going to be provided to the government in tax, and your net income is about $22,400 per year. If we look at an insured annuity, and for this example, again, we're using $1 million, and I'm using a male age 75, and we can do specific ages and time. So for this illustration, we're just using a male age 75. The annuity income that would be generated from this $1 million investment is about $108,000 per year. This is where it's important to note the difference. The tax is only about $4,700, or there's only just over $10,000 of the annuity income that is considered taxable. So we reduce that income by $4,700 of tax, and because we want to return the principal to our estate, our children, or a charity, we have to insure the principal, and the annual cost to insure it is about $55,000. The net result is cash flow of about $48,300 per year. So that's more than double what we would get from a GIC. And again, it comes back to it's what you get to keep that counts, not what you have. But importantly, when we look at OAS clawbacks, on the GIC, we're having to report income of about $40,000. And if we have $67,000 as our threshold, that only gives us $27,000 plus a little bit of other income before we're going to start hitting our OAS clawback. Where in the insured annuity, we only have taxable income of about $10,000, so that gives us a lot more room to take income from other sources before we start losing our OAS, or we start to have OAS clawback. So again, it's interesting to compare these two in the way that it's what you get to keep that counts, and the cash flow off of an insured annuity can be very, very strategic, and we use these quite often with retiring farmers. It's important to understand that this is just an illustration. Annuity rates, interest rates, tax rates, everything vary. So if it is something of interest, if you wanted to have a quote specific to your situation, you could, at the end of this webinar, there'll be 1-800 numbers that you can look at, and you can just give us some basic information, and we would be more than happy to prepare an individual quote for you. So that's my presentation. I'm going to pass it over to Stino Scaletta from Myers Norris Penny. Stino?
Okay, Dave, thanks very much. We've got a little bit of time. Well, just if anybody's got a question or two for Dave at the moment. Dave, you going to stick around for a little bit?
Yeah, I'll be around. I've just got a little bit of technology issues here, but yeah, no problem. If anybody has any questions, please feel free.
Yeah, so like I said, we've got we can take a few seconds or minutes just to have any questions. So Dave, do you think that a lot of farm families are aware of the insured annuity, or is that a relatively new development and you're trying to get the word out?
Well, it's not new. It's been around for a long time. Insured annuities get very popular when interest rates become challenging, when there's not a lot of alternate out there, when we're looking at interest rates that are at 3 and 4%. It's hard to get enough income off of our investments, so insured annuities become very popular. I think it's not something that people just think of all the time. It's sort of a product that has to, the advisor puts it in place to be specific to the farmer's situation. And it's also not something you want to tie up all of your capital in, because it is an income stream. It's like a pension. Once you do it, you got the income stream, and you don't have the use of that principal until it's returned at the time of your estate.
Okay, well thanks, Dave. Looks like we got a couple people typing their questions in, Dave,
No
so we'll just wait for them and see what they type in, and then we can certainly read it to you, and then you can respond.
Great.
So I understand technology's maybe not great in where you're part of the world, but we can help you out.
Well, of all days, our internet crashed this morning.
Oh, it crashed this morning?
Yeah.
Why not, eh?
Yeah. So it happens once in a while out here, but it happened this morning of all times.
Okay, one of the questions, Dave, is from Doug, and his question is, at what age do you suggest starting an insured annuity?
They're effective usually in the 60, 65 plus range, all the way up. It all depends, but usually in around that 60, 65 is a good time to look at an insured annuity. Almost lines up perfectly when you're looking at retirement income times or retirement times.
Okay.
And it can go, like when I say it starts at 60 to 65, that's when they cash flow well. But the later you wait, there's not a problem. The only problem is that because if you want the insured annuity, when you want that principal to be returned, you do have to qualify it with health. So you have to be, the person taking the annuity has to have reasonable health. So that's what can be the problem with delaying too long. As the older we get, generally there a few cracks in the mortar start popping up.
Okay. Dave's next question is from Wayne, and his question is, can money be rolled into the insured annuity from farmer's registered plan as well as a spousal registered plan?
Well, if the funds are registered, the tax advantages aren't the same. So this is for the illustration that I've provided is for non-registered annuities. We can do a quote for a registered annuity, but it's not going to have the same tax preferential treatment that we get with a non-registered annuity, non-registered assets.
Okay. Maybe we'll just draw, if you don't mind, Dave, we'll just draw the questions to a close and move on to Stino, if that's okay?
Sounds great. Hope you guys have a great presentation.
Yeah. Okay, the next presentation is Stino Scaletta. Stino is a partner and tax specialist with Myers Norris Penny in Brandon. He has been with the firm for 19 years, 14 of which he has devoted all of his time to tax research and specialized tax planning. His role is to support the Westman team members and the clients by providing an up-to-date tax solutions for a variety of business and individual entities. Welcome to the Farm Leadership Council, Stino. Stino, please proceed with your presentation.
Thanks, Don. I'd like to thank the Farm Leadership Council for the opportunity to share some ideas on the tax side for succession planning. And time permitting, I'll throw in a few tips and traps that we should watch for as part of our succession plan. As Dave stated earlier in his presentation, many farmers do not like to do a succession plan. And recent surveys showed that 80% of all businesses in Canada are family-owned, and only 1/3 of those businesses are currently planning for their retirement or succession. And the question becomes, why aren't more owners building a succession plan into their exit strategy. And one of the answers is they don't realize how important succession planning is for the survival of their business. And two, they think that they have enough time to plan, but in reality, a lack of adequate time is a major reason behind failed succession planning. Here at MNP, or Myers Norris Penny, we feel that you need at least 5 years of lead time in order to properly plan for your retirement from an income tax perspective. And that time might be even more if you want to plan to effectively transition the mind and management from parent to child, because the child might not be ready to make the important decisions. So again, you got to weigh both sides on a transition plan. You want to make sure that the next generation can handle running the operation, and also you want to have enough time so that you can be in the proper structure so that on the transition you're minimizing tax to the best possible, the best way you can. The succession plan is not a single event. It's a continuation of a process, and it will be tweaked over time as different scenarios pop up. Just to let you know, a succession plan can either be the transition of the farm from parent to child, or there are scenarios where the children are not interested in taking over the farm, so the succession plan in that case would be to how do we properly set ourselves up so that we can sell the farm to a third party. What I'll be covering is more of an understanding of the rules that the Income Tax Act provides for farmers with respect to transition and the capital gain deduction. And what this slide here shows is we're going to go over the transition rules. Rollover of farm assets to children is one area where farmers have a real advantage compared to non-farming business. Again, the Income Tax Act has just a ton of good stuff in it for the farmers, especially when you compare a farmer to a non-farming business. And there's two types of transfers that the Act provides. The first one is what we call an inter vivos transfer, a living transfer. So while the farmer is alive, certain assets can transition from parent to child. And the Act also provides for a testamentary transfer. While upon the passing of the farmer, again, certain assets can transition from parent to child. The types of assets that can transition include farmland and buildings, farm equipment and machinery, farm quotas, an interest in a family farm partnership, and shares of a family farm corporation. If the farmer owns any of these assets and they meet the criteria in the Act, these assets can transfer from parent to child. Now, the Act also provides another luxury for the parent in the way that the proceeds on the transfer can be set by the parent, and the parent can set the proceeds anywhere between the tax costs of those assets and fair market value. Obviously, there'd be different motivations why you want to trigger income when you select proceeds above cost, but again, that's all specific to the client situation. One thing to note, when you look at the quota, the Act only provides for an inter vivos transfer, so while the farmer's alive, there's a rollover to a child, and for some reason doesn't provide for a testamentary transfer. Again, if you are holding quota as a proprietor, you definitely want to come up with a plan on how you deal with that, especially if there's a death that happens accidentally. The way the rules work with respect to the transition rules is that the property must be owned directly by the farmer, and before the transfer, the property must have been used principally in the business of farming, in which the farmer the spouse, or any of the farmer's children were actively engaged in a regular and continuous basis. The key part of this definition is principally used. Principally used is not a defined term in the Act, but over many interpretations in court cases has become to be known as greater than 50%. Give you an example how this works. If the farmer owns a combine and uses the combine 30% of the time to take off the crop, and the other 70% of the time the combine is used for custom combining, and the farmer now wants to move the combine to the child, well, this combine would not be considered an eligible asset because it wasn't used principally in farming. Custom combining is not considered a farming activity. Another example, we have a farmer that has farmland and has owned it for 30 years. The first 20 years the farmer was farming that land, and the last 10 years that land was being rented to the neighbor. We're in year 30 now, and the farmer now wants to move this land to their child. Well, this land will qualify for the transition rule because it was used principally in farming. It was farmed longer than it was being rented out. One key asset that's not on this list is inventory. Inventory cannot be transitioned from parent to child during the lifetime of the parent. It is possible to move the inventory as part of a testamentary rollover, but again, if the child is not going to continue in farming, that means they have other income, and when they liquidate or sell off the inventory, that inventory will more than likely be taxed at a higher rate. Again, you definitely want to have a plan in place and have a contingency plan for emergencies such as a sudden death in the family. The other definitions in the Act that relate to farm property concerns the capital gains exemption. There are two sets of rules with the capital gains exemption. One relating to property that was acquired before June 18, 1987, and the other set of rules deal with property acquired after June 17, 1987. For the type of assets that are eligible for the capital gains exemption include farm land, farm quotas, an interest in a family farm partnership, shares of a family farm corporation, and for the non-business community, shares of a small business corporation. Again, if you own any of these assets and it meets the criteria in the Act, then you would have the ability to use your capital gains exemption on the disposition of these assets. If you compare this list to the list on the previous slide, you'll notice that farm buildings and farm equipment and machinery and inventory are not eligible for the capital gains deduction. The way the rule works is, and I'll explain the first rule first. So if you bought farmland in 1980, this is how the rule will work. The property had to have been used principally in farming by the individual, in this case here would be the owner of the land, or the spouse, parent, or child of the individual, or a family farm partnership or family farm corporation, in the year the property is sold, or in at least 5 years which the property was owned by the individual, spouse, parent, or child. Getting back to our example, if the land was bought in 1980 and farmed from 1980 to 2000, and then the land was rented from 2000 till today, and the farmer wants to sell the land today, because the land was being rented in the year of disposition, we don't meet that definition. But if we look at Part 2, we farmed it from 1980 to 2000, so that's more than 5 years. Therefore, we meet the criteria in the Act, meaning that we can use the capital gains deduction on that land, even though we've rented it for the last 10 years. The other rule, dealing with property acquired after June 17, 1987, has a more stricter application to it, and it's more than likely put in the Act to discourage hobby farmers from accessing the capital gains deduction for this very reason. What this rule states is that for a 24-month period before the disposition, the property had to be owned again by the individual who owns the property or spouse, parent, or child. And while that property was owned, the gross revenue from farming that property had to exceed all other sources of income for that person. Here's an example. If the farmer bought the land in 1990 and farmed it from 1990 to 2000 again, and then rented it from 2000 to today, and during the time the land was rented, that farmer was working in the oil patch, let's say. Well, this land would qualify for the capital gains deduction because for a 24-month period, the only source of income for that person was from farming, and he therefore would meet the criteria of the gross revenue test. However, if the person who buys the land post 1987 and also has off-farming income at the same time, and that off-farming income is greater than the gross revenue from the land, that land will not qualify for the capital gains deduction. One way to remedy that is perhaps not work or scale down the off-farming activity so that for a 2-year period, the gross revenue for that person is from farming that land. One nice thing about how the rules are written with respect to the capital gain deduction is that they're written in the past tense. Provided that any person that we mention here, like the spouse, parent, or child, or the individual, qualified the farm property with these rules, that qualification stays going forward. For example, again, if the person buys a land in 1990, qualifies it, and then has off-farm income after the qualification time, that qualification will stay when they sell the land. Similarly, we can transition the land from parent to child, and the child does not have to be a farmer and still will be able to use their capital gains deduction on the disposition, for example, of farm land. The only caveat there is that the child has to hold on to the property for a minimum of 3 years. If the child sells the farmland in this example before the 3rd anniversary, any gain on that land would attribute back to mom and dad. If the child holds it for more than 3 years and then sells the farmland, the child will be able to use their capital gains deduction on that disposition because mom and dad qualified that land, and that qualification stays within that family chain. A couple of side effects to be aware of with the capital gains deduction, and Dave mentioned one of them, meaning we got to watch out for the hidden tax associated to using your capital gains deduction. When you have a disposition of, for example, farm land, and it's eligible for the exemption, it does remove the income tax part of it on part of the calculation, but on another part of the tax return, there is tax that could apply, and the first one comes in the form of AMT, which stands for Alternative Minimum Tax. The hidden tax also could come in the form of the clawback of the old age security, the clawback of the GST credit, and for those who may be who have children, it could result in the clawback of the child tax benefit. The AMT, or Alternative Minimum Tax, can be a significant blow to cash flow. The AMT is a prepayment tax, so the farmer should be able to get it back over the next 7 years, but we're experiencing scenarios where someone who's triggering a significant capital gain, and if that capital gain is around $750,000 and you're using the full $750,000 of exemption, the AMT on that could be as high as $40,000, and that could provide a big cash flow concern in April when the taxes are due. So be aware that if you're doing any planning on disposing of farm property, that you want to make sure you know up front what the potential cash flow will result in. There are ways to minimize the AMT and perhaps the clawback of old age security and the other benefits, such as spreading the disposition over time if that's possible, taking back a capital gain reserve if that criteria is applicable. So there are ways to hopefully minimize that impact of what we call the hidden tax. A few tips and traps to be wary about, and the first one is having co-owned farm assets. There have been many technical interpretations on this topic, and basically what they're stating is that qualified farm property jointly owned by what we call qualifying persons, such as spouses, children, or parents, will meet the principally used requirement in the definition for qualified farm property, meaning greater than 50%, which is a good thing. If farmland's owned by parent and child, we're okay because parent and child are considered qualifying persons. But property jointly held by non-qualifying persons, such as brothers, will not be considered qualified farm property because each co-owner can't be considered to principally use the property in the course of carrying on business of farming in Canada, which may create some problems where you have two siblings going out and buying farmland. By reading through the technical interpretations, we find that the Canada Revenue Agency will deem the real property, which is farmland owned by a farm partnership, to be considered qualified farm property as long as the other criteria for the farm partnership meet the test. Therefore, you can have farmland that's co-owned by brothers put into a partnership, and then it's the partnership that's using the land and not the individuals, and therefore we get by the principally used criteria that was affecting the two brothers who own the land initially. There are other ways to also fix this problem where you have two brothers having multiple interests in land. You could technically do replacement property rules where you swap the land between the two brothers so that in the end each brother would wholly own a quarter section of land. So that's possible as well. There are scenarios where on the transition of farm property to child that the parent just wants to gift it across, which is allowed because of the transition rule. Just to note, any transaction between related persons has to go at fair market value, and the exception to this rule is the transition rules that we mentioned earlier, which can go anywhere between cost and fair market value. The scenario that pops up on occasion is where, again, parent wants to move the property to child. The parent has capital gain exemption remaining and wants to use it because after the transition they're not going to have any access to use that capital gains exemption. And they also want the child to benefit from the step up in the cost base because when the parent uses their exemption, the cost base goes up from the original cost to what they set the proceeds at. But the parent wants no consideration back from the child. Unfortunately, when you do that scenario, it's considered a gift, and a gift is deemed to transfer at cost, so the child will never get the step up in the cost base in the land. In order to remedy this problem, what has to be done is the parent has to sell the land according to a legal written transaction to the child. Let's use an example here where the land's worth $100,000 and the cost is $10,000. So on a normal gift, the land would go across at $10,000 and the child would get the land with a cost base of $10,000 and an inherent gain of 90 grand. But in order to get around that, the parent will sell the land at fair market value to the child. the parent would have a $90,000 capital gain and use their exemption to shelter the tax on that. Child would, in order for the child to get the step up from the cost base from $10,000 to $100,000, the child has to pay for that land, and the payment can be in the form of a promissory note going back to mom and dad. Now, in order to finish off what we call the gifting part of it, mom and dad will put in their will a provision stating that upon their death, any obligation owing to them from their child will be forgiven upon their passing, thereby technically creating a situation where we have a gift of the farmland. If for whatever reason mom and dad want to forgive that promissory note while they're alive, they can do that, but what they're creating is a scenario where we have debt forgiveness happening to the child, and that debt forgiveness is going to result in an income inclusion to the child to the amount of the debt that's been forgiven. For example, in our example here, it's going to be $100,000. The way the debt forgiveness rules work is that $100,000 will come into income in a specific order for the child, and basically what will happen is that 100 grand of debt forgiveness is going to wipe out the cost base that the child received, taking the cost base from $100,000 back down to zero. If the farmer just transferred it as a rollover, the child would have had the cost base of at least $10,000. So very important that if you want to structure the deal as a gift, but use your capital gain exemption and have the child benefit from your capital gain exemption, you have to structure a deal as a purchase and sale and then forgive the amount in your will. There have been situations out there where people didn't want to go that route but wanted to do what they call a check swap in order to get around it, whereby parent would write a check for $100,000 to child would take that money and then go buy the land from mom and dad and pay back that $100,000 check for the land. Well, these scenarios have been in front of the courts, and they determined that because both parties didn't have the cash in the bank, that it wasn't considered a gift of cash, but it was more like a gift of land, and then the land went at cost base, thereby nullifying their transaction. So again, the importance here is that if you want to prepare a gift, you need to have the child buy the land with a promissory note and forgiven upon the death of the parent.
Yep. If you, we need to have Chris involved here, so if you could wrap up in the next 5 minutes or thereabouts.
Sure. Okay.
Okay.
The next slide deals with having non-farming assets in your partnership or your family farm corporation. And the big concern here is we may be messing things up for transition and for the capital gains deduction. And the main thing here is that in order for the family farm partnership or corporation to qualify for the rollover of the capital gains deduction, 90% of the fair value of the assets have to be used actively in the business of farming. The accumulation of excess cash may taint the status of the farm partnership or corporation. And the definition of excess cash is cash that is sitting idle in the partnership or corporation that's being rolled over in T-bills all the time. If the cash amount is not depleted during the year when you buy your inputs, then that's considered excess cash. And the goal here is if you are in that scenario, we have to come up with a way to transfer that cash on a tax-deferred basis into another entity, thereby what we call purify the partnership or corporation so that it does qualify for rollover and a capital gains deduction. And that's about it for what I have to say.
Well, you had a couple more slides. You want to cover those quickly, or?
I think it'll be too much time, actually, Don.
Okay. All right. Well, thanks very much, Stino. So now we'll move on to Chris Geldert, Chris started his career with PricewaterhouseCoopers. In 2003, Chris joined the life insurance industry, providing guidance to financial advisors in the area of estate planning and transitioning the ownership of corporate assets. Today, Chris is a member of the Daystar Financial Group's Tax and Estate Planning Division, where he continues to provide case support to a select group of advisors from Alberta, British Columbia, and Saskatchewan. Chris, welcome to the Farm Leadership Council. Please proceed with your presentation, Chris.
Thanks, Don. It's a pleasure to be here. I'm based out of Calgary, and I guess we're getting probably the same weather as you guys are getting, so it's good that everybody's inside. Just to recap sort of, what's been discussed so far, obviously Dave Watson was talking about retirement and, really offering some different ideas to, help structure our retirement and maybe focus a little bit on, where's our retirement income going to come from? And then, of course, with Stino Scaletta talking about, different ways of transferring assets. Really what I want to talk about is estate planning, which really is taking both the retirement and the succession planning and hopefully wrapping everything together. Normally when I talk about estate planning in presentations, one of the first things I ask is just to get individuals to think the term estate planning. What do you normally think about when you hear the term estate planning? The common responses that I receive are, something to do with death, usually wills. A lot of times people will mention, lawyers and accountants. And really a common theme that's brought up is something that's complex. Now, what is estate planning really? Well, it definitely encompasses all those different areas. It does deal with, well, what happens when we pass away? What are our wishes and how are we going to make sure that our wishes are followed? Well, that's where wills come in. And obviously lawyers and accountants have a part in terms of our planning, but really it's a process, and the key is that it is a process that's going to allow us to arrange our affairs in such a manner that, again, it's going to encompass our retirement. As we accumulate assets, we're going to take those assets, and obviously we're going to use some of those assets in retirement. And if we have an understanding of what we're accumulating and what we're going to require in retirement, it's going to give us a better idea in terms of the projected remaining assets, how are we going to end up distributing those. In terms of estate planning, I really like to view it as the roadmap of our lives. Like any trip before you start out, I find it's really helpful to know, where are we now and where are we going. The exact same with an estate plan. So again, as I've talked about, we're going to focus on the accumulation of assets. We're going to focus on, well, how are we going to use those assets in retirement? And then finally, the estate plan should, and the key of it is obviously, how are we going to transfer those assets to the next generation? Now, since our lives are continually changing, our estate plan obviously should be reviewed on a periodic basis just to make sure that it's still meeting our needs. So the plan that we put in place today, things change in life, tax rules might change, so it's a good idea to certainly continue to review those plans. The first step in any planning process is something that's often referred to as an information gathering component. The way I look at that, here's a great opportunity really to get to know ourselves and our family better. A lot of the work that I've done, I've worked with financial advisors across the country for the last 8.5 years, and had the opportunity to work with a number of farming families. And one family in particular that we were working with in terms of sitting down and gathering information, when we were talking to the parents in terms of what did you want to have happen to your farm, essentially what came out of it is we're transferring the farm to essentially our eldest son. He's the individual who has expressed a desire to actually take over the farm. And what we found is when we were sitting down and gathering the information, talking to the individual family members, is the eldest son actually was only farming out of a sense of loyalty, really had no desire to continue farming, whereas one of the younger children who had actually moved to the city really wanted to come back and take over the farm. So through doing that, it really changed the focus in terms of the estate plan that we're looking to put together for that particular family. If we look at a typical estate plan, it might provide for something similar to what you see on the screen here, where we have a variety of different assets. You know, we have the farm, we have registered investments, so your RSP, we have non-registered investments, we might have some insurance, probably have some land, obviously, included within the farm. Most wills are structured in such a way that upon a first death, all the assets transfer to the surviving spouse. And then on the second death, the remaining assets might be divided equally amongst all the children. Now, one of the benefits of that type of structure is obviously that it's very simple and it's very easy to understand. In terms of some of the cons, though, from really focusing on a very simplistic plan such as that, is, well, it might not be as tax efficient. Now, Stino talked a little bit about, or a lot about, different ways that you can transfer certainly farm property from one generation to the next, and certainly that's one of the biggest benefits that the Income Tax Act provides to farming families. Without really looking at and developing that estate plan, though, what we might end up doing is creating a structure that maybe isn't tax efficient. And if we don't have a tax efficient plan, really what we're doing is we're maximizing our gift to the Canadian government, which for most business owners and certain farmers that I've talked to, that's not something that's high on the list of entities that we want to give more money than we absolutely need to. But more importantly, it may not actually meet our intentions, specifically if we're considering the farm. In dealing with clients from across the country, really it's a very rare circumstance where more than one sibling actually wants to continue to take over the farm. And by sharing the farm in terms of ownership amongst several children who are not going to be involved actually creates some difficulties for the child who is trying to continue that farm. So once we've established where we are and where we want to go, certain problems and definitely certain opportunities usually present themselves. Trusts are one structure that's commonly used in estate planning. In the example on this slide, the farm could be transferred to a trust where the farm child, so the child who's going to take over the farm, and perhaps their children, so your grandchildren, are the beneficiaries of that. The benefit of that type of structure is obviously you're protecting the ownership of the farm. By transferring the farm into a trust, if we take a look in a common potential issue, certainly for farm families, is, well, what happens if my son marries and he now has the farm? What happens when they divorce? Well, a trust is a good way to protect the farm from that scenario. Another use might be a spousal trust, which could provide an opportunity for income splitting. So maybe some of the investments upon the first death go into what's called a spousal trust. Without going into the details of the taxation of trusts, all we need to know at this point is that there's an opportunity for income splitting by utilizing that trust. So we can split the income between the trust and the surviving spouse. And in some circumstances, by creating that structure, we've been able to use it really to the benefit of the spouse to ensure that they receive all the government payments that they're entitled to, So going back to the first part of the presentation when Dave Watson was talking about that old age security, you know, if you make too much money, the government's going to start taking back some of those payments that they have given you. Well, if we can split the income, maybe we're going to protect and allow you to actually keep more of that old age security, so more of that benefit payment from the government. In terms of creating an estate plan, you know, really whose job is it? Well, we have the lawyer, and they're there, and they'll prepare the wills and probably some other legal agreements, and they'll provide some advice. You might have an investment advisor or a banker who you deal with, and they're really going to help you build your assets for retirement, and they're going to provide you some advice. You likely have a pretty good relationship with your accountant, and in most times they're actually the most influential advisor because, again, that's the one that you see at least on an annual basis, if for nothing else, to prepare your tax return. And they're going to provide some advice. And then the fourth one is the insurance specialist, and really their role is to provide protection to ensure that the goals that we've set up can be met. And they're going to provide some advice. The problem, however, is everybody's providing some advice, while no one likely has the entire picture. And to further complicate the matters, is everyone, including yourself, are extremely busy. So it's very difficult to get everybody working on essentially the same page to prepare a plan to make sure that your roadmap works the way that it needs to work. So to work effectively, it's usually helpful to have one individual sort of coordinate or take the lead in terms of, number one, leading the family through the information gathering process, so finding out where we are now and uncovering what the objectives are. Once the information has been gathered, there should be a sharing of information amongst the different advisors, so with the lawyer, the accountant, the investment advisor, and the insurance specialist, to ensure everybody has the necessary information, and that will allow us to develop a plan that will meet your needs and objectives. As mentioned a number of times, estate planning certainly can be somewhat complex, and really for an estate plan to be beneficial, it really needs to be understood by you and your family. Again, an estate planner or someone who's going to take the lead in this type of process, part of the benefit that should be added to that is the ability to explain exactly what is happening and what is the ultimate benefit to you and to your family. So if we were to take a look at a common scenario, and don't focus so much on the actual numbers, more just the idea. For most farm families, obviously a significant value is going to be tied up into the farm and to the land. If we took an example of a farm and land that has $2.5 million, it's worth $2.5 million. Maybe we've created a good investment pool. We have $350,000, and perhaps we have a little bit of life insurance. This is sort of from our financial picture. This is where we're starting. So this is the where are we now. If we look at the family, well, typically in most farm families that I've dealt with, there's usually a pretty large family, but only one child really expresses interest in continuing the farm. For the purposes of this scenario, we're going to call that person the farming child or the farm child. So for sake of argument, let's assume our goal is to transfer the farm intact to that farm child? Well, one solution might be to transfer the farm directly to the farm child, with any remaining assets being split amongst the non-farming children. Well, by doing that, if we consider the value that's actually being transferred and shared amongst the children, if we have $2.5 million transferring to the farm child and the investments in the insurance, and let's just say it's $350,000 being split amongst the other non-farming children, well, really what's going to end up happening is in all likelihood, there's going to be some tension amongst the siblings. And that's obviously, in terms of estate planning, that's something that we want to eliminate. So we want to make sure that, number one, everybody's comfortable with the plan that's put in place, but recognizing that if we give a majority of the assets to one child to the exclusion of the others, we will create some discourse amongst the siblings. So one option, if we go back to that simple alternative described at the beginning, well, maybe we can just divide all the assets equally. We're going to give the farm child that portion and an equal portion of the farm to the non-farming children. Well, does this meet our desired goals? Well, it's hard enough farming, let alone having other non-farming children with an ownership of the farm. So what we tend to find dealing with farmers is this is something that really rarely works in practice. The farm child needs to really focus on the farm and needs to have control. The non-farming children, to the extent that they're owners of the farm, will really just hinder the success moving forward. So to maintain family harmony, it's usually necessary to ensure that everybody's comfortable with the plan. One family that I recently met with, they were renting the farm to their eldest son, and they were planning to use those rental proceeds that they received on an annual basis to help provide an equitable share for their other two children. The problem with the plan that was put in place that they were currently working with is that this extra rental income was causing the parents to have their old age security clawed back. In addition, the amount that was being paid in terms of the rental payments was actually hurting the farming child, as they were providing so much money in terms of rent, they weren't actually able to maintain a living or a successful living through the farm. To take it even a step further, the amount of the rental payment that was being paid to really compensate the other non-farming children, the amount of time that the rental payments were going to be required was very significant. And again, just essentially hindering the farm child. So one of the solutions that we're currently looking at is having the farm child pay the premiums on a life insurance policy on the lives of the parents, which would ensure the funding to ensure that there's an equitable split amongst the non-farming children. And really what we're hoping to do is we're trying to create a situation where we're reducing the cost to the child. The parents are already taken care of from a retirement perspective, and it's going to provide a way that we're going to ensure that there's this family harmony. So at the end of the day, there's lots of options, and it's very important to have everybody, your accountants, the lawyer, your investment advisor, and the insurance specialist, all working together for you to ensure that the plan, the roadmap that we're putting together meets your needs and your family's objectives. And it starts with you. You are the catalyst obviously you're the one who creates the roadmap, deciding on where you want your family to go. So where can you find the answers? And I didn't mean to have my picture come up at the very beginning. You can either go to the cafe, you talk to your neighbors, you can talk to your friends and find out what they've done, which is a good idea to get an idea of perhaps what you want to have happen with your family. Though you have to hope, if you're going to do that, that their roadmap is going to be the same as yours. But as we know, every family is different, and every family dynamic is going to be different. So we can talk to our families, we can talk to our friends and neighbors, or we can look and seek out a specialist such as myself, such as Dave, and such as Stino. So really, at the end of the day, we're here to help you. There is a toll-free number listed on there, 1-800-663-5793, which will put you in touch with Dave, myself, or Stino. So that is my presentation, and I will now open the floor up to questions.
Thanks, Chris. Appreciate the presentation. Anybody who's on the line, now is the time to ask the questions. We have a few minutes, about 10 to 15 minutes for questions, so let's make use of it. You can either unmute your phone by *6 and pose your question orally to one of the three gentlemen who are speaking to us, or you can type, get to your keyboard and text your question, and then Stino or Chris can respond, and if it's directed to Dave, we can relay the question to Dave and he can respond that way. So now's the time to press forward or ask some questions to make use of these gentlemen's time. Stino was going to talk about, he's got a couple slides that he did not proceed with, but one of them was talk about the tax implication of an auction, and more importantly about the structure of your farm, whether it's a proprietorship or partner, corporation, or joint venture. So if you want to ask questions on those two particular areas, you can do that. Stino, was there anything within a minute or two you could talk about while we're waiting for some questions about proprietorship or structure, pardon me?
Well, just to mention that there are various structures that can be used for your farming operation, and those may be appropriate for getting you through your succession plan, but you can also start in one scenario, being a proprietorship, and move into a partnership or corporation for exiting out of farming. And the reason you would do that would be to minimize tax or provide for another avenue for a child, let's say, to buy in, because some structures are more efficient for cash flow in regard to a business. So if a farmer wants to have the farming child actually pay for some of the equity in the company, there are different ways of using the different various structures to accomplish that goal.
Well, thanks, Stino. And there's a couple of folks typing questions in, so okay, here we go. One question is, it doesn't say who it is, but you guys can figure that out. What is a typical cost for a single-family estate planning consultation?
I can answer that, or Chris, but generally we don't charge any cost for initial consulting. We look at the situation, meet with the client, look at the situation, come up with some general ideas of the direction we should go in, and then as we get specific, as the recommendations are acted on, then there's costs involved for maybe the reorganization of the farm or establishing corporation. So as the sort of the outline of the direction we should go is established, then specifically when certain actions are taken into place, there may be legal fees or accounting fees, that type of thing. But generally there's no upfront fee for a consultation.
Okay, hopefully that answers Doug's question. If not, please type in, Doug, if you need some more information. We're waiting for a couple of folks to proceed. And Stino, well, here's a question. Are there provincial differences in tax and transfer costs and procedures, i.e. BC or Alberta? And that's from Aaron.
Not quite sure what they want here, but yeah, each province would have what they piggyback on the federal income tax, so that there are different tax rates in each province, and it could impact on the exit strategy for a farmer on whether they're going to get paid or not. But on the rollover part, if they're planning to move the assets at cost, then there should be no tax associated to that. I'm not quite sure if I answered that question or not.
Well, thanks, Stino. And if that didn't answer Aaron's question, please type in a question so we can get further clarification on what you're looking for. There's another question, and Dave, you included. It says, to all presenters, the question is, why do you think farmers are reluctant to discuss estate planning amongst their neighbors, but will discuss openly with individuals such as yourselves? What are the biggest hang-ups?
Personally, I find that farmers don't want the neighbors to know their personal situation. There's a lot of farmers keep their finances and their net worth very close to their vest, so they prefer not everybody in a small town to know exactly what they're worth or their personal details. So quite often, by bringing in a professional into it, they can open up, and they know that all of their conversations are in secrecy, or not secrecy, but confidential, and don't get spread around the town.
Yeah, and, just to add to that, and you know, that definitely is one of the biggest issues. Sometimes it's easier to talk to someone who is not in the same town as the individual. But definitely one of the biggest hang-ups that I've found is more in terms of talking to the family, even in terms of what a parent has and what a parent's plan is. I think, in my mind, that's probably a bigger issue, where you think about, you know, again, this idea of the roadmap and, you know, where we're wanting to go. It really is important that the kids are involved, or at least understand the plans for parents. You know, part of Dave's comment at the beginning, the idea of, you know, from the child taking over, a lot of the conversations that they have is, well, ultimately, when is that farm going to pass to me? Or what are the parents' plans? So by opening up the dialogue and having that discussion, we do find it does alleviate a lot of the tension within the family.
I agree with both comments. I did a presentation yesterday at Ag Days here in Brandon, and I was approached after my presentation, and the farmer, they just do not want to bring up this topic with the family, and he basically gave me the full family history right on the spot, and he only knew me from my presentation. So I agree with the two comments made by Dave and Chris.
Okay. Well, there's another question. The question is, what can you do with parents who refuse to discuss the issue of estate planning with the farming children? And that's from Doug. I imagine a lot of folks in that situation, so can you help out, ladies and gents?
That's a very complicated one, and every situation is different. You have to have a candid conversation with the parent, but you know, it's not unique. There's many situations like this where people are just, because of the family dynamics, because of stresses, that sometimes the ability to procrastinate becomes easier than dealing with it, and that's not a great answer. But unfortunately, it is the way that a lot of families operate. The best thing is that you try to convince to the parent that it's in everybody's best interest to get around the table and have a conversation. And then the other thing is that it's a good idea to communicate that can be done confidentially and with a professional at the table that can answer everybody's questions. And the other one that we do quite often is we'll go and meet with the parent and then everybody individually and sort of get a feeling of what's going on in the family, where if you put everybody around the table, nobody wants to speak about what the differences are or what the pressures are or what the stressors are. So quite often we'll go out and talk with the parents individually and go meet with the kids individually and try to be the catalyst of getting everybody together at the table, understanding the dynamic.
Chris or Stino, any comment?
No, I agree with Dave too. You got to take it in small pieces, and the small pieces being separate meetings in the beginning to kind of soften the resistance. And the ultimate goal is to have a group family meeting so everyone's opinions are on the table and hash out a plan from there. But I agree with Dave. You got to take small bites at first when you're encountered that situation.
And one of the other things that I found too is quite often it's one or two specific things that have got everybody at a stalemate or a logger's head. And when we see and we can point out that there's easy ways around it that they haven't considered, that's what the catalyst is to getting to the next level. That's when we can see where the roadblocks are, where the pinch points are. We can sometimes make suggestions that they haven't thought about, and we can relieve those pressures, and then that puts everybody at a better place to talk around the table.
Okay, so hopefully that gave Doug a bit of an indication as how we might approach it. If not, he can type in the question to clarify a little further, or maybe he needs to call you folks directly and just have a further discussion. And Chris, you indicated a number that he can reach, or any of the folks on this morning can reach you, a gentleman, at any point in time. Is that correct?
Absolutely.
Yep. So we've got a few minutes. We've got about 5 minutes to proceed with some questions. So if anybody's got some questions, please unmute your phone, as I said, by pressing *6 and pose your question orally, or continue to get to your keyboard and pose your questions via text. So I suppose, looking at Doug, maybe one approach, Dave, and I suppose you've used this, is maybe not to talk about the farm transfer of the farm, but talk about what their hope and expectation is for the farm overall.
Yeah, absolutely. Sort of just get what the stressors are out on the table, and then can identify cures for those, or if there are some cures or ideas, we get around them, and then go to the next level.
Yeah, that's correct.
I dealt with a situation where the clients were new to MMP, but what happened was Dad was a big control person, and the two boys that farmed with Dad didn't have any clue with the management and the running of the farm, and then Dad passed away, and the two boys now they're older. We're doing succession planning for them to move the farm to their kids right now. But the two boys, again, they were really green with respect to the management of the farm and financial reporting requirements, and they really needed a lot of hand-holding to get them through that stage, because Dad called all the shots and would not, from my understanding, allow for any input coming from the bottom up, and he never really prepared the boys to take over the farm.
Yeah. We had a situation where the parents, specifically the father, didn't care for the daughter-in-law, and he was going to leave the farm ultimately to the son and daughter-in-law. And his biggest concern and why he wouldn't deal with it was his dislike for the daughter-in-law and the fear that once it was transferred to the son, if there was a divorce or whatever, that everything that they had worked for in their lifetime would be divided in half, and half of it would go away. And when we sat down and explained that there's ways around that, there's trusts and all kinds of things that we can put fences around assets and move them for the betterment of his family, is when they allowed them to sit around the table and talk about a succession plan without having to say in front of his son and his daughter-in-law that he didn't really care for her. So, I mean, family dynamics are very different, and whatever the pinch point is, when you identify it, generally there's a cure, and when you get that on the table, it relieves everybody's stresses.
Yeah, no question, Dave. There's a question again from Doug, or a comment, The issue is not actually with myself, but a younger neighbor who would like to know what the direction the farm will take. He does not have a hand in the management, but his parents refuse to disclose their future plans for turning over the farm. That's the end of his comment.
Yeah. I have a few situations similar, and it's a tough situation. I have one scenario in Manitoba where the parents control all the assets and the son really wants to know what's going to happen, but the parents strictly say they're their assets and they're keeping their cards close to their vest, and I have to respect that, and both of the parents and the son are my clients, and we just can't seem to be able to have a conversation involving everybody. It's their assets and it's their direction and it's what they want to do. So sometimes we can't get past these, but quite often we can. It truly is identifying what is the catalyst or what is the reason for holding those cards close to the vest. And when we get that out and there is a cure, sometimes that's that point that allow it to get to the next level.
And sometimes in terms of providing that catalyst, sometimes it's as simple as explaining, what will happen if we sort of just put our heads in the sand and ignore everything. There's obviously some reason why they're using to disclose their future plans. It is, unfortunately, it's more common than I think we would like to believe, but a lot of it is, I guess, a fear as well, in terms of, if I don't really understand what's going to happen, maybe it's better if I just leave the issue alone and not address it. Where if I know that if I do nothing, I'm actually going to create a larger problem down the road. We've had some success in terms of at least getting the parents to sit down and talk about their plans. And again, as Dave was mentioning, the idea of meeting with the parents, meeting with the children separately, sometimes allows or eases them into that process.
Yeah, Dave, and maybe you've done this, I'm not sure, but you might invoke the services of a family coach or whatever.
Quite often we play that role
Okay.
as the insurance advisor or when we start heading up the estate plan. Quite often we become the quarterback and between the family and the other professionals.
Yeah. No, we've had Elaine Fraze on here a couple times last year, and that's another role that she might be able to play too, but you obviously are doing that as well, Dave.
Yeah.
Yeah. So we're just about out of time here. I know we looked like there was a question coming, but it hasn't shown up just yet. And I'm sorry, Stino, I cut you off a little early, but we've got a minute or two. Do you want to have anything to say about tax implication of an auction?
I believe Wayne's question popped up there.
Oh yeah, there it is. Okay, thank you. Okay. Wayne's question is there a huge relief factor for farm families that are successful in completing a succession plan? Does the health improve by relieving the stress?
I think absolutely. Personally, every time I've seen it, everybody functions better. It takes the 900-pound elephant out of the room when they're having family functions. It's 100% healthy if a well-structured transition plan is put into place. Absolutely is a stress reliever, and it keeps the family tight. And it's not just the parents and the one child that have the stresses that are going to take over the farm, but it's the non-farming children also that look at the son that's a likely person to take it over, and if nobody's talking about it, it looks like he's the gifted child that's going to get everything, and people start getting their nose out of joint because the size of farms and the worth that is out there now, they're very, very big, and you don't want it to look like one child's going to inherit it all and be the gifted child. You want to make sure that there is a spirit of equitable distribution. It doesn't have to be equal, but it has to be equitable. So it is a big stress reliever in my experience.
Okay, thanks, Dave. As closing, Stino or Chris, any comments on that question or comment?
Well, just to, agree wholeheartedly with, what Dave said. It's almost like a weight is lifted by having that conversation because again, everybody understands now what's happening. Parents sometimes don't realize, well, maybe there's some dissension amongst the children that maybe they're not seeing, because obviously when the families get together, maybe everybody's putting on, their happy face, where sort of behind the scenes, that's not actually what they're feeling. So it is very therapeutic in my mind to have those conversations and to really, place the plans out in the open so everybody does understand and understands the rationale as well. I think that's just as important.
The fellow I was talking to yesterday after my presentation was stressed to the max, and farming is pretty stressful to begin with, and then you add that on top of it. You got to really look out for your health when you're encountering that situation. So I agree that once a succession plan's put in place and everyone's on the same page going forward, I can imagine that the stress level would greatly decline.
Okay, unfortunately we have to draw this session to a close. Thank you, Dave, Stino, and Chris for reviewing an area that can be confusing and frustrating. You provide some information and options that hopefully will prove beneficial to participants today and in the future. Bottom line, developing an estate plan takes determination, perseverance, knowledgeable advice, strong family communication, and perhaps more importantly, a strong sense of humor to see you through some difficult issues. However, the final end product in terms of estate planning can be very rewarding for farm families and the family business. Thank you again, gentlemen, for your presentations. Stino, Chris, and Dave, have a great day and a great weekend.
Thanks very much.
Thank you.
Thank you.